Welcome to the channel. I'm James, and today we're looking at Verizon Communications Inc., ticker symbol VZ. What we're going to be doing today is looking through their most recent financial statements, then looking at my models, which is a discounted free cash flow and a buffer grim intrinsic value model to see if this stock is still a buy in 2022. Then in the back end of the video, we're going to be looking at some technical analysis. So what's happening with Verizon right now? It's currently around $52.91 a share. It has had a pretty bad year on the whole, but had a rebound strongly after earnings where it went from about $50 to $52. So at the start of the year, it was about 60. Can we get to those heights again? That's the question I'm going to answer today. So firstly, let's have a look at my steps. Verizon currently has a market cap of $220 billion. Share price, as I said, of $52.91. It pays a very healthy 4.8% dividend, and the ex-dividend date is the 8th of April. So buy your shares before then if you want to get paid. Is the PE ratio less than the market? Yes, it is. Verizon has a very low PE ratio of 9.95, and the market's average is around about 26. So that is a massive pass. Next, we want to see that the revenue is increasing. And you can see here, revenue is increasing, but ever so slightly. 130 billion to 133. So that is a pass. But let's have a look at the financials. So we have the most recent one, 2020 Q4. We have the 3 months ended in this column of 21, 3 months ended of 20, and the 12 months ended of 20 and 21. So how does Verizon make its money? Well, it's split into two services on the revenue. Services, revenue, and other. Wireless equipment and revenues. And if we look at the quarter was actually down from 2020 compared to 2021, 28 billion to 26, 6.4 to 7.3. Overall, that was 34.6 for the quarter, but 34 on the quarter flat. So the quarters were down, but if we look at the year, you can see this is a much better story. Services and revenue up 110 billion compared to 109. Wireless services and revenues up quite a bit, 23.1 to 18.4, that is up 25%, and overall 133.6 billion to 128.2. So revenue is up quite a bit. Next, we want to see if Verizon's profits increasing, and yes, very healthy there, 15.5 billion in 2018 compared to 22 right now. And if you see how do we get the profit, where you can see the net income is here, and to get profit, it's revenues minus expenses. So let's see what the the expenses are like. We'll just look at the 12 months for the revenues. See, cost of services pretty much flat, wireless equipment's flat, selling and general administration expenses down a little bit, and depreciation and amortization expenses pretty flat. So overall, 99 billion in 2020, 101 in 2021. And obviously with these revenues, you can see that gives us about 4 billion in difference, 18.3 to 22.8. Also, if we look on the quarters here for the net income, 2021 was slightly higher, but once again, about flat, but increased from the previous year and increasing from 2018. So on to the next step. First, can you please give a like on the video? It gets this video out to as many people as possible, and it really helps me out, and I'll keep on helping you guys out with these very nice videos. Hopefully you enjoy them. Right. Next, are they buying back their shares? No, they're not. 4.08 billion to 4.5 billion. And if we go back here, we'll have to find the shares outstanding. In fact, let's just search for it. You can see here, this is the weighted average shares outstanding, and they have issued more shares up each year. Verizon seem to be issuing shares every single year. Now, this is a bad thing because it dilutes shareholders, but on the positive side, if Verizon use this capital correctly, then it can be beneficial because it rewards shareholders through increased share prices and therefore also increased dividends as well. So not necessarily a bad thing, but something that we need to keep an eye on. And finally, is the free cash flow increasing? No, 16.2 billion to minus 28.3. So that is a massive disparity. So let's go to the cash flow statement. To get free cash flow, what we have to do is take cash flow from operating activities, which is this line here, minus capital expenditures, which is just this line. So we can see in 2020, the net cash from operating activities was 41 billion compared to 39. So that is actually down. And capital expenditures are up 18 billion to 20. But the way you would think, well, this would be 19 billion and this would be about 20 billion. But no, the reason why is because of this line here, acquisition of wireless licenses, that has gone up massively. Only 3 billion in 2020, 47 billion in 2021. And let's just have a look what that is. I've lost the sheet, obviously. There you go. Verizon's the top bidder on the 5G spectrum, committing more than 45 billion. So you can see here, the FCC has announced the winners of an 81 billion auction license for the important airwaves for 5G. The big winners were Verizon and AT&T. Verizon spent 45 billion and AT&T spent 23. So that is why this cost is up now, which is in turn why we have such a low free cash flow for this year. Not necessarily a bad thing. Once again, if this they have no free cash flow though, they're spending it on other things. Yes, it's got negative, but if they can use this purchase to then drive up the share price, drive up revenue, and drive up profits, then it's not a bad thing in the long term. So what does that give us? Well, it gives us 3 passes, 2 failures, shares outstanding, free cash flow. Free cash flow ratio here is broken because this takes the most recent year. But if we take the average, which would probably be about 20 million, this is a much lower number. And the dividend is usually safe, 10 billion in dividend, when they normally have a bit more free cash flow, obviously minus 28 in this year. Now we want to look at discounted free cash flow and the Buffett Graham intrinsic value to give the fair value of Horizon based on now. Verizon, I think I said Horizon there. Anyway, what I've done is I've actually taken 2021 out of the equation here based on these averages. Because if you look here, the averages of these are actually about 104%. So let me just increase that to 104. We're going to say that they're not going to spend 45 billion on licenses every single year, but you never know, they might. But let's have a look at what the first value is. So this gives 20 billion in free cash flow going out, and not a very large increase. But even then, if we look at that, that would give a calculated stock price of $163.34, which is a 208% discount. So that would be a massive, massive increase. I think that is a bit on the high side. Always difficult with these companies which have large free cash flow. Because they are slower growing. AT&T, before they went into their issues with free cash flow, had always a very nice discounted free cash flow valuation. So not always the clearest, but I like to combine it with the Buffett Graham intrinsic value because this gives us a very different look. Earnings per share and expected growth rate is what we look at here. And that actually has a share price of around $75 a share, which I think is a lot more reasonable. So currently, $52 a share can go up to 75, which is a 43% discount. So both models are saying it's a buy, but I would say lean on the Buffett Graham intrinsic value a little bit more closely with a $75 a share. So let's just quickly have a look at some technical analysis for the year. We've got a 50-day in red, a 100-day in yellow, and a 200-day in red. I said that backwards, 50 in green, 100-day yellow, and a 200-day in red. So what are we seeing right now? Well, overall, the price has been below the major moving averages, which is a very bearish sign. But more recently, you can see the price broke above. That is bullish. The prices are currently above 2 of the major moving averages, which is bullish. But you can see that recently the 200-day has acted as a point of resistance. When the price hit there, it broke below it. It didn't break through it. It went back down. And then when the price did below break all 3, it jumped up again. You can see here on Jan 7th or Jan 3rd, the 50-day acted as a support. And it looks like we've seen a very similar thing here again. So if the price breaks above the 200-day, then we'd have a sort of unparalleled or unprecedented within the recent time bullish movement to the upside, but it looks like we have been pretty consistently with these levels of support. Let's have a quick look at the MACD. I'll just delete these lines here, and the MACD is the moving average convergence divergence. Let's add that up and we look at the daily level here. So what is MACD telling us? Well, there you go. There is some bullish signs right now. Why is this bullish? Because the MACD line and the signal line have crossed, also displayed by this green on the histogram. So that is a buy signal. Another bullish signal here is that the price, both of these lines are above the 0 line, which is bullish. You can see here it was underneath, despite it was switching, going red to green, but it was overall underneath, which was bearish. It switched at this point. That would have been your buy signal, and you would have bought and you would have sold at, well, what, 53, buy at 50, sell at 53. So that's a nice little profit there. But overall, MACD is looking pretty bullish. And finally, we like to look at the RSI, which is the relative strength index. Is the stock in overbought or oversold regions? On the daily level, you can see it's actually pretty average at the minute. Normally, Verizon over the last year has been trading in the oversold regions or leaning towards oversold, but right now it is around about flat. It hasn't gone overbought up until about May. So I would say it's been pretty reasonable, but more on the positive side than it's been recently. And if we look at the weeklies, this is a longer average, so this goes back to 2019, and you can see once again it is kind of in the middle. So most of the technicals are saying it's a buy. MACD has switched, it's above the major moving averages, but RSI is saying it's kind of in the middle. But the main reason why I like this stock as a buy is the Buffett Graham intrinsic value model saying it's a buy at $75 a share. Right guys, thanks for watching the video. Please give a like if you enjoy it, and I'll catch you guys next time.